Good morning. On behalf of NYU Law School and KPMG, I'm delighted to welcome you this morning to the 16th annual NYU KPMG Tax Lecture. My name is Larry Pollack, and I'm an international tax partner with KPMG, a graduate of the LLM program here at NYU and the proud director of this annual symposium. By way of background, this annual conference was created to provide a unique forum that brings together high-level government officials, tax professors from NYU Law School, distinguished members of the bar, and KPMG tax partners to discuss, explore, and debate issues of current interest in taxation. The theme for today's program is Navigating the Global Tax Climate Change. Dramatic changes to the global tax ecosystem are happening, causing multinationals to modify corporate behavior in ways we have never seen before. Major recent changes to the global tax environment include the OECD's Base Erosion and Profit Shifting Initiative, referred to as BEPS, which clearly is at the eye of the storm, the EU Commission's State Aid cases, the political debate in the United States concerning international tax reform, the increasing mandate for global transparency and information exchange, and most importantly, corporate concerns over reputational risk. Today's program is going to aim to focus on the practical aspects of this sea change in the global tax environment. We're going to cover topics including the 2016 U.S. Model Treaty, which is reflective of this change paradigm, impact of a new environment on corporate tax departments, observations concerning the proposed debt equity regulations that could have a substantial and wide-ranging impact on cross-border taxation, the economics of international tax reform, the need for efficient and effective global dispute mechanisms for controversy, and selected foreign country perspectives on BEPS and the prognosis for the future. Our keynote speaker today is Robert B. Stack, the Assistant Secretary for International Tax Affairs in the Office of Tax Policy at the United States Department of the Treasury. Following his keynote speech, Mr. Stack has graciously agreed to join a debate session where several propositions will be debated. You will have a chance to weigh in with your views during the debate session. We expect this to be quite a lively debate given the topics that were selected for discussion today. Our distinguished speakers today include from NYU Law School Professors David Rosenblum, Daniel Shaviro, Willard Taylor, and visiting professor from Brazil, Luiz Choueiri. From the bar, Paul Oosterhuis of Skadden Arps, leading economists, including Alan Viard from the American Enterprise Institute, Eric Toder of the Urban Institute, also from the United States government, Ted Setzer, the Assistant Deputy Commissioner International with the Large Business and International Division of the Internal Revenue Service, Quinn Huynh, Associate International Tax Counsel with the Office of International Tax Counsel of the U.S. Treasury Department, and representing corporate America, Harris Horowitz of BlackRock, Joe Vaccaro of MetLife, Kanti Srikanta of IBM, and Louise Weingrod of Johnson & Johnson. From KPMG, Peter Blessing, Jason Connery, Manal Corwin, Sean Foley, Sharon Katz-Perlman, Michael Plowsian, Tom Stout, Brett Weaver, and from the foreign country perspective, Adrian Crawford representing Ireland, Penny Chen representing China, Justin Davis representing Australia, Russell Fielder representing the United Kingdom, and Pierre Kremer representing Luxembourg. We will invite audience Q&A at the conclusion of most of the segments today, and so at that point in time, if you have any questions, just raise your hand and a microphone will be brought to you. There will be 2 breaks, one mid-morning, one mid-afternoon, and a buffet lunch at 12 noon. The breaks and lunch will be served across the hall in Greenberg Lounge. Administrative procedures for CPE and CLE credits. For New York State CPE credits, assuming you've signed in at the registration desk upon your arrival, you will simply need to submit your evaluation form at the end of the program as you depart. There's no need to formally sign out for CPE credits. To obtain New York State CLE credits, assuming you've registered in advance and upon arrival you've signed in and received your name badge, at the conclusion of the conference, simply drop your name badge in the basket that will be designated for CLE credits on your way out and submit your completed evaluation form. There's no need to sign out for New York State CLE either. However, for those attending who have not pre-registered for the conference, you will need to officially sign in and sign out and submit your completed evaluation form to qualify for CPE or CLE credits if you have not pre-registered for the conference. And the certificates will be emailed to you in approximately 2 months. Kindly put your cell phones on vibrate or silent ring, please. And with that, let's get started with the program. To set the stage for the theme of today's overall symposium, our opening panel will discuss the disruptions to the global tax ecosystem. That is, what is changing and why is it happening? The panel will be moderated by Sean Foley, head of KPMG's Global Transfer Pricing Services. Prior to joining KPMG, Sean was the director of the Advanced Pricing Agreement program at the Internal Revenue Service. Panelists include Professor David Rosenblum and Tom Stout. Professor David Rosenblum is the James S. Eustice Visiting Professor of Taxation and the director of the International Tax Program at NYU Law School. David is a member of Kaplan and Drysdale and served as International Tax Counsel and director at the Office of International Tax Affairs in the U.S. Department of the Treasury. A frequent speaker and author on tax subjects, David has taught international tax and related subjects at Stanford, Columbia, the University of Pennsylvania, and Harvard Law Schools, and at other educational institutions around the globe. Tom Stout is Director of Federal Tax, Legislative and Regulatory Services with KPMG's Washington National Tax Office. Tom is the past chairman of the AICPA Committee on Tax Policy and Legislation and holds a graduate tax LLM degree from Georgetown. Gentlemen.
Thank you, Larry. So is this going to jump on me? Well, actually, because this doesn't work, it's not a problem. No. Because the, oh, got it back? Here we go.
There you go.
Yep, but I jumped it twice here. All right, got it. So the idea for this next 50 minutes is that we're going to have a conversation, and we're actually not going to use the slides. You've got the slides, they're in your deck. I think they're actually pretty interesting and useful, so take a look at them at your leisure. But we thought it might be more interesting to try to engage in a dialogue up here about 3 of the most important disruptors that we are seeing in the tax world today. BEPS, international tax reform from the US perspective, and transparency and reputation. My panel here, and particularly I think David has been spending quite a bit of time thinking and talking about BEPS, and I guess I want to start off with, we're very familiar, I think, many of us, with the ins and outs of the BEPS Action 15 points. But for BEPS, is there anything, I'm just going to put a real loaded question on the table here. Is there anything positive for the U.S. about BEPS?
Yeah, I do think there are some positive things for
tell us why we should be happy to have BEPS.
Well, I'm not sure happy is the right word. I think that one thing BEPS has done that's of near-term benefit is that it has made mandatory arbitration in the mutual agreement procedure a real possibility. The United States has 4 treaties with mandatory arbitration, and it's a pretty good system. It's really worked very well with Canada, which is the one country we've had actual arbitrations. I think BEPS has lent legitimacy to mandatory arbitration. We see mandatory arbitration proposed by the United States in the new model treaty, so I think that's a sort of near-term good aspect that comes out of BEPS. And if it were accepted by a number of countries, it would go a long way toward making international cross-border disputes a lot more manageable, and it could do a lot of good. On a broader note, I think BEPS is also beneficial because I think over time it's going to cause the United States to, it's going to push the United States in the direction of doing a rethink of its international tax rules. We've been, as far as I'm concerned, way too long focused on outbound taxation to the detriment of the inbound tax rules. And it seems to me that there's a rebalancing that's needed there. And BEPS is, if nothing else, BEPS is clearly the revenge of the source basis taxation world. And in order for us to play in that world, we're eventually going to have to move in the direction of rethinking rules that we put in place in 1966 and basically haven't changed since. So we have 50 years of essentially the same rules on inbound. I think those rules really should be rethought. It's not going to happen anytime soon, but it will eventually happen in my view.
So in looking at the U.S. rules, you know, we had an important publication of the new U.S. model treaty. You just mentioned that.
Yes.
And do you see the influence of BEPS in that document? Is that a document that is picking up on what the OECD is trying to accomplish?
Oh, I think the model is indisputably linked to BEPS. I mean, it's got aspects. It's got anti-abuse rules and anti-treaty shopping rules. It's clearly developed with BEPS in the background. It didn't necessarily track everything that was proposed in BEPS. For example, in the permanent establishment article, it didn't pick up some things that were said. But it's got it's BEPS inspired in many respects. From my perspective, it's still largely working around the edges because, again, our model puts us way out at the extreme in favoring residence taxation over source taxation, which of course our law does, our statutory law does as well. And that's where we've always been. I would like to see, again, it's not going to happen soon, a more careful review, shall we say, because I don't know how it would come out, of whether we're in the right posture insofar as we approach the world with that model. We are beyond the OECD in terms of favoring the residence country over the source country. I'm not sure that's the wisest position for the United States in a BEPS world.
And in the BEPS world, though, just to return to your first point about arbitration, you know, I think, you know, one of the concerns I think many of the people in this room have is the strong expectation of a lot of disputes.
Yes.
You know, while BEPS as a project was supposed to create uniformity, it was supposed to create you know, a global consistent approach to international tax, I think there's a strong view, a strong concern that it's not going to land that way, and that particularly perhaps what we're going to talk about in a minute, some of the new transparency is going to be bringing a lot more battles to the table. Do you think that this multilateral instrument, and particularly this coalition of the willing, I mean, it's a relatively small group of countries that are decided to go down the path of arbitration. I wonder if this is enough for us to declare that this is a good thing for the United States.
Well, skepticism is warranted, no question about it. I mean, look, the goal of a mandatory arbitration rule in a treaty is to never have a mandatory arbitration. That's what you're aiming for. Mm-hmm. We have 4 treaties that have got mandatory arbitration in place, and we haven't had a single arbitration under 3 of them. I actually have been party to cases that were pending for long time, 5-6 years, and that were settled the moment mandatory arbitration was announced with one of those countries. So the only country that didn't seem to get the memo was Canada, and you know, even there, I think there's some room. I perceive some room. I have a number of cases with Canada. I see some room for movement on the Canadian side. They're a little more hesitant to come to the table. Look, if we started doing mandatory arbitration in the developed world, which is what this coalition of the willing is, I think, I don't know who's all signed on to it, but I think it was quite a few countries.
Yeah, it's a dozen, more than a dozen.
So I think that would have a big impact. And I think it also might have the effect, it should have the effect, of allaying some of the fears of the developing countries who think that mandatory arbitration is going to be a ruse, a way for them to lose in the arbitrations. Frankly, I don't understand the thinking of a developing country that wants to enter into a tax treaty but doesn't want to resolve double tax cases. If they want to resolve double tax cases, mandatory arbitration is a reasonable and fair and extremely efficient way to go. I don't think we've done a very good job, frankly, of publicizing how well we've done with mandatory arbitration. It's really been a remarkable success for the United States insofar as Canada is concerned.
So let's turn to BEPS and the U.S. government, particularly in the Congress. So far, there's not been very much of any action at all. And I guess what is your expectation as we sort of look at tax reform and think about how BEPS might play into that?
Well, I mean, my expectation is for a lot of talk and not much action. I do think that BEPS is going to hover over whatever is eventually done in Congress. In other words, I have no illusions that Congress of the United States is going to pay much explicit attention to BEPS or take it into account in developing legislation. But I think it's sort of inevitable, if and when we ever do get serious about legislation, that the existence of BEPS will be in the background. If not from the Congress, there will be commentators comparing what we do. There'll be other countries comparing what we do. There's a huge expectation out in the world generally, and I speak in a lot of countries often about what's the U.S. going to do about BEPS. That's a very pressing issue in Europe. I've been at conferences in Asia, in South America. People want to know, what is the U.S. going to do? And it does seem to me that no matter what Congress does specifically, the BEPS impact is going to be there. What they do is going to be compared against BEPS. There's going to be commentary. I think it's unavoidable, frankly.
And do you think that the NGO world that has sort of been a very, very loud voice, particularly in Europe and in the developing world, not I think it's forceful in the political debate here. Is that an aspect of what's going to drive some of this policy debate, or is it just going to be good legislating?
Well, that's a good question. I think the NGOs are very present in the work of the United Nations, and I think that we need to pay attention to what's going on there, because that forum is being run to a large extent by some very important developing countries, and China, India, Brazil, particularly, to a lesser extent South Africa. I think that the NGOs have a big influence there, largely because they're willing to put up the resources, and the UN is kind of starved for resources in the tax area. But I see that having a big effect via that route. I don't see that as being as big an influence on what we do legislatively as BEPS. I mean, BEPS, look, to my way of thinking, BEPS is the most significant thing that's happened in international taxation in decades. And it's not going to have any kind of immediate impact, but it's just a huge undertaking, and regardless of what we do, the rest of the world is paying very intense attention to it. We've had lots of seminars right here at NYU on the impact of BEPS in Brazil, the impact of BEPS in Mexico, the impact of BEPS in Australia. Those are real seminars that we've had this year. And it's going to continue. I don't see how how we can escape that having an impact. The NGOs, I think, are probably a more indirect effect on what we do.
Okay. Well, Tom, we just heard from Dave that it would be an important part of tax reform. We would anticipate would be some type of a BEPS overlay. But how about tax reform itself? Is this something that is actually in the cards, or and in our near future, or is this a distant dream?
Well, as David says, there's a lot of talk about tax reform, but we've had talk about tax reform for the last, whatever it's been now since the '86 Act, 30 years, and we haven't gotten very far. And I think sort of backing up here, it's been about 2 years since then Chairman of the Ways and Means Committee, Dave Camp, did what everyone's been clamoring for a long time and put out a comprehensive tax reform proposal. And it taught us a couple of things that I think are important politically to understand tax reform. The first thing is, on the individual side, which is largely what drives tax reform, because most individuals are what influence politicians. What happens there is what influences politicians. Camp came up with a comprehensive proposal that was both revenue neutral, which is what he was supposed to do, and distributionally neutral. It didn't redistribute the tax burden among various income categories. And what he came up with at the end of the day was a proposal that had a 35% maximum effective tax rate, maximum tax rate. That was not anything that got anyone politically excited. Reduction in tax from 39% to 35% was not the kind of thing politically that members were looking for. And it got the reaction that one might expect politically, and that is that it just sort of died. So that's one of the things that was instructive about Camp, I think. The other thing that was instructive is, apart from the individual side, he had a business reform, a set of reforms that were at least ostensibly revenue neutral, although he did the usual kinds of budgetary tricks that legislation members always do in Congress when they're working on tax legislation. But it was at least ostensibly under the 10-year budget convention revenue neutral, and it had a 25% maximum rate, something that you would think would have gotten at least people interested in it. And that also went nowhere. And I think the instruction there is that business tax reform politically has a lot less cachet than individual reform. Members are mostly interested in individual reform and individual rates. Business reform generally is really secondary to that.
So, if we have this history of failed, proposals, what would actually unlock the key and actually make comprehensive reform move?
Well, it's a good question, and I don't know what the answer is. I mean, what's happened, what's going on is, members have not been ignorant of what happened to Camp. And what we're seeing now, what's going on in Congress, I think, in the background is revisiting other types of reform proposals that we've seen in the past. I'm not sure they have any more chance of success, but we have, I think, serious looking going on now at things like consumption taxes of various sorts, VATs, business cash flow taxes, X taxes and the like. We see that retreat, and we also see that coming out of the proposals in the presidential campaigns that are going in that direction, seeing the lack of progress on the individual side, at least.
Tom, are those consumption taxes that you hear talked about on the Hill, is the idea that they would be a replacement for the income tax, or they would be in addition to an income tax?
Well, that's a good question, and I don't know the answer to that. They could be in addition to, as a way to reduce rates. We've seen that kind of thing happen, especially outside the U.S., where increases in VATs have been used to reduce corporate tax rates and the like, and that could be what they're looking at. The proposals on the presidential side, the campaign sides, have been replacement.
Right.
I don't think anyone's really focused very much on the nature of consumption taxes, which have all sorts of political problems. They've been proposed before. Steve Forbes famously, proposed one back when. The problem with consumption taxes at the end of the day is, economists like them because they provide an extra incentive for savings and investment, but the way they do that is exempting savings and investment from tax. That what that amounts to at the end of the day is shifting the entire burden of the income tax from capital to labor. I think there are going to be political problems with a serious proposal along those lines, unless you do something like some of the presidential candidates are proposing, which is large tax cuts along with that. If you have $8 or $10 trillion to spare, you could probably get everyone on board with a consumption tax if you had those kinds of reductions. But realistically, we can't do that because of the deficit. We're not going to do that. And a revenue neutral type of consumption tax, does entirely shift the burden of tax from capital to labor, which is probably not going to be very popular.
You mentioned, you talked about individual reform and you talked about corporate reform. What about the possibility of pure international reform, just dealing with the cross-border? Because I think particularly in this conference, many people are concerned particularly about that. And also, I go to conferences and I hear people say, well, we could at least peel off the corporate piece and deal with that. What do you think of that, the prospect of that occurring?
I think individual maybe, corporate probably not. I mean, the reason why there's little interest in corporate reform, as was indicating before with the Camp proposal, is that in addition to being very little interest in the general public in doing corporate reform, it's actually a negative politically from a member's point of view. Because if you think about it, it's hard for a member to go back to his district and explain why he's done something to reduce the corporate tax rate and done nothing on the individual side. Even if it's revenue neutral, that's a hard kind of thing for a member to explain to his constituents. So very difficult. On the international side, clearly what drives tax legislation generally, or any legislation, is what's going on publicly, what the public perceives. And inversions are clearly the thing that had the public's attention. It still has the public's attention and therefore the members' attention. Probably misunderstood generally. I think the public sees inversions as companies moving offshore and taking all the jobs and everything with them, which is not the case, obviously. But that's the public perception. And what we've seen in congressional interest in this is trying to respond to that phenomenon. That's not to say there aren't real reasons for international reform, because there are. I mean, it's probably the area most in need of reform in the code. We have large differentials in our rates versus rates offshore, which is what's driving the inversions. It's driving profit shifting, creating the earnings stripping issues that we've seen. So there's real reason to do international reform, and I think we may get there eventually, but it may be a while. And in fact, what Treasury's done with the new interest stripping regs under 385 is maybe reduced the pressure a little bit. I think maybe despite all the complaining in Congress about Congress's authority the president's authority to do this kind of thing from a regulatory standpoint, there's also some relief from the pressure to do something about inversions, which had everyone's attention.
So do you think that in this election year, perhaps in a lame duck session, or and of course we have other aspects of legislation such as the treaties, which are stalled, do we have some sense that we could break some of the logjam in 2016, or is everything we're talking about here a 2017 plus play?
Definitely 17 plus.
So you're completely negative. Nothing will move in 16.
I don't see any prospect of anything happening this year.
Okay.
No.
There's prospect for a lot of talk.
We can't decide on the shape of the table,
Exactly.
let alone international reform.
That's clearly true.
All right. Well, that's a good pessimistic sort of story here. Glad to make sure everyone has their day started off
Always
appropriately.
safe.
Well, listen. Let me turn to this last of our three topics, the idea of transparency. And I think of transparency in two buckets. The first part is information exchange. And this one is the one that interacts with BEPS and has an awful lot of legs. And I guess I'd just like to sort of think about this, starting with my own story. When I was at the IRS 15 years ago, I used to, as APA director, get requests for information about APAs that some of the taxpayers that were in front of me from other governments. They were looking for insight into what kind of transfer pricing methodologies and other aspects of these APAs. And a couple of points at that time was that number one is that this was probably the lowest priority of things that are on my desk. And number two is that frankly we were perhaps quite willing to find reasons not to provide the information. A very classic one was relevance. It had to be relevant. So that was the status quo 15 years ago. Then time moved along, and particularly I think the breakthrough here was JITSIC and the tax shelter world, and the U.S. and U.K. and then a group of another coalition of the willing came together and really began sharing information. And now what we see in the field is real flow of information cross-border in exchanges of information, and not just exchanges of information, but for example, I have a number of clients who are receiving IDRs, from foreign governments that are being processed by the U.S. government. The IRS is in here seeking information in an IDR format from U.S. taxpayers in response to Mexican audits and French audits. So obviously a very new day just on the ground, the way in which all the governments, and particularly the U.S. government, is interacting. But then we add to that, some other important things. Obviously, we had FACTA come through, but ultimately, this year we have the country-by-country reporting that all of you in the room have been paying attention to, and of course, that's the very first piece of BEPS out of the box. It's the one that has been enacted. We now are counting, I think, 33 countries around the globe that have either enacted it formally or indicated either through proposed legislation or statements of government that they will be enacting country-by-country reporting. So the C-by-C effort and the information that's going to be on the table as audits begin essentially in 17 and 18, still a ways out, but it will be the information with respect to this year, 2016, that will be on the table. And I guess one thing that I've been thinking about in the context of C-by-C reporting is the C-by-C report is supposed to be a risk assessment tool. It's supposed to be when the tax authority picks up this report, they're supposed to say, okay, which taxpayers in my jurisdiction should I be auditing, and what are the issues that I should be going after? So risk assessment. It's not supposed to be an actual audit adjustment tool. It's not supposed to be, for example, I see a pile of income sitting over here in a low tax jurisdiction, and I don't see very many employees. I see a lot of employees here. Maybe we ought to just find a permanent establishment and attribute profit back here, and let's get the tax. And that kind of a very aggressive use of this form and the information on it, I think, is a huge concern. Now, one of the things that I find helpful is that the U.S. government, and Bob Stack, he will be here later to talk to us, has noted that would be an abuse of the form. This form is really supposed to be for risk assessment. So there's a question on the table is that if the governments around the world and the tax authorities, in particular tax inspectors, begin to use this aggressively in the audit context directly, will governments like the United States step up and ultimately threaten to withhold the information and use peer pressure, and will that help keep some of this more aggressive use of this information in line? And I guess I wanted to ask David, do you have any confidence that that some of the leading governments, such as the U.S., can help police the use of this form? It is going out through the treaty network. We do have part of the protocol within the OECD on C-by-C is to use it only for one purposes, not others. Can we enforce that?
Well, I think that question really is one for Bob. My own sense is that we can't. BEPS is, BEPS is a creation of Europe. If you read the documents, it really is an OECD document. We participated, obviously, and Bob did, I thought, heroic work in trying to defend U.S. interests. But this is a European product. And by the way, when I say that, I mean it literally. I mean the Asians. There's a whole book coming out on BEPS in Asia, and I think the Asian countries, a lot of them feel that they weren't really fully included in the BEPS discussion. This is a pure OECD product, but it's not a US product. We didn't control it. To some extent, if you go back in time and sat back and said, how did BEPS come about? I was thinking about this. I think the key development in the United States is probably the check-the-box regulations. I think the check-the-box regulations, which have never really been fully understood outside the United States, possibly not fully understood inside the United States, but certainly not outside the United States, I think that that led to a lot of planning that was perceived as very aggressive. I think BEPS is a byproduct of all of that. And my own sense, I didn't say this earlier, but my own sense is that what we're going to get from BEPS is a broader assertion of source basis taxation. The rest of the world is no longer content to just take our word for it that they ought to reduce tax at source, and we'll take care of it as a residence country, because we haven't done such a great job of that. So, I think they're going to assert their own interests, and I think it's going to be somewhat chaotic. And I don't think it's going to be as automatic as you portray in terms of the use of information. I don't think it could be that you're going to find information that's provided that finds its way directly into some kind of adjustment. But I do think that this information is going to feed into a broader assertion of source basis taxation, more disputes. And from all of that standpoint, this is all terrible news from the standpoint of U.S. companies. As I said earlier, the one thing that could salvage this to some extent is if we can figure out a way to resolve the disputes in an efficient way. I think the last thing we want is for companies to have disputes ongoing in major countries throughout the world. It's a terrible prospect, not just from the standpoint of wasting resources, but also it's going to give the financial accounting industry fits. I mean, you're going to have all these adjustments, and what are they going to say on reserves and everything? Mm-hmm. It seems to me it could be quite complicated for companies. But if we can figure out a way to get the disputes resolved reasonably efficiently, I have a lot of confidence in this, in the people who are available to do these arbitrations around the world. I think they're competent and they're fair, and I think they do a good job.
Tom?
Do you think U.S. international tax reform that limited some of the tax planning done by U.S. multinationals might reduce the pressure that BEPS might create for source-based taxation outside the U.S.?
I think it's probably a little late. My sense is that some of the, frankly, viewing this, and I'm, as everyone knows, I'm a practitioner as well as an academic on this. The one thing that's always missing in analyzing problems is judgment. And in fairness, I mean, it's always, hindsight is always 20/20. But some people in some of these countries, including major countries, took advantage of various plans that they either came up with on their own or were sold to them, and did things in countries which stripped out the tax base. And I don't know how they could have thought that major countries around the world were going to sit there and just take that indefinitely. That's why I think that the planning, we tutored the world on tax planning. Now we've got, okay, the UK is in our league now, and probably Germany's getting there soon. But we basically led the lot, and I think check the box is at the core of that. I think that's where it was coming out before check the box, but check the box sort of let the genie out of the bottle as far as I'm concerned.
Yeah, and actually I think a very clear indicator of the importance of the link between Check the Box and the BEPS project for me is the very first report from February of 2013 when the BEPS roadmap was put forward. There are 3 diagrams in the back of that lay out which are seen to be the classic tax play that BEPS wants to get after, and they're all check the box. I mean, they're basically BV/CV strips with interest and hybrids, and they're all very, very close on U.S. tax planning. The other part of transparency, just to sort of maybe round out my thought, that is I think very much on the table today, is perhaps what we might call inadvertent transparency. At least that's where we are today, and I'm really thinking about LuxLeaks, more recently, although more focused on individuals, the Panama Papers, but perhaps even other things like the state aid cases have actually brought information into the public domain that I think was not expected to be in the public domain. And clearly, we also had a series of very sharp presentations in the U.S. Congress and Parliament. So information, sort of coming out into the public domain that was not expected to be. And I guess as I sort of think about this, That's another aspect of reputational risk, but what's interesting to me is also as we go into this new Action 13 world of not just C by C, but the master file. The master file is actually, importantly, going to be filed under local law. It's not going to be filed with treaty protection. And an important point of this is that if you think about where some of the most sensitive information about how a corporation is structured, the way in which it handles its IP, the way in which it organizes its supply chain, this kind of information, which can be very sensitive business, commercially sensitive, is not in the C by C report, which is going to have this very strong treaty protection. It's actually going to be in the master file, and it's going to be filed locally under local protection. And I think an important issue for us is to understand is that are we really going to be able to see that protected, among many jurisdictions around the world, or will it wind up in the public domain? And if it winds up in the public domain, is the language in that master file that describes your business, is it going to be fully consistent with the types of information that are also being provided to the public in the 10K filings? And so there's a whole new area of tax practice that I think where in the past when we thought about tax filings and tax information, we were talking about a dialogue between the company, the advisors, the taxpayer, and the government. But now, I think we really need to be thinking about the public being at the table there. And that means that, for example, that corporate communications and other sort of types of review are going to have to be in there. And it also means, I think we're going to have to be very careful about what we put in that master file, because in fact, if there is commercially sensitive information and it's leaking out, that's a real world consequence that that I think the tax in the past was not expecting.
Yeah, let me underscore a point that's implicit in what you just said, which is important, and I think it's perhaps a little bit, it's not appreciated fully, which is that there has been a conflation throughout the world of the individual level and the corporate level. Now, if you're working in the corporate world, you tend not to pay all that much attention unless you're a financial institution to what's happening with respect to Panama Papers or FATCA or the individual level disclosure. But I don't think the public distinguishes between the disclosure of corporate information and the disclosure of individual information. So while for most companies, and certainly most companies in the United States, I would have thought the disclosure of the Panama Papers is a non-event. I would be astonished if there was that much presence of U.S. companies in any of the Panama material. I haven't heard it, not that I necessarily would, but I would be surprised. But that's a very important event because that's captured the attention of the public. And when you capture the attention of the public, in turn you capture the attention of the politicians. And my sense is that the Panama Papers is in some sense a threat not just at the individual level, but generally. Public's not distinguishing between making information available for companies and making information available for individuals. This transparency idea conflates the two. And I think that I don't know what you do about that, but I think that recognize it is important. And your comments go to there because LuxLeaks and all of that, a lot of that is, some of that is corporate and some of it's not. State aid is corporate, Panama Papers is largely individual, but still they all go together. And they push this drive toward transparency. I have no idea what the European Commission is up to in that area, but I suspect that we're going to see something dramatic come out.
No, and that was actually the next point I wanted to turn to is that, so then, we've been talking about LuxLeaks and some of these is inadvertent, but then we're suddenly getting the European Commission is saying, look, let's actually formalize this. Let's take the C by C report. It's not exactly the OECD version of it, but something very close, and let's publish that. Let's make sure that the public accounts and the websites of the companies have a detailed, set of accounts as to where you're paying tax, what kind of activities you have. Again, the C by C type information. This is in a proposal at this point, but it is importantly this proposal is coming through the financial accounting standards within the EU governance structure. And for that reason, it does not require unanimity to take this over the line. And for that reason, I think there's an expectation that this could very well be enacted. And I think that's a big concern, I think, for many public companies. And I mean, just one aspect of this that's come into play is is as I'm sure people will talk about later, we have this delay in the C/C reporting for the United States. There's a question about would companies who are being required to file C/C reports around the world, they can't file them in the United States for 2016, so do they use a surrogate? If you use a European surrogate, is your information then going to be published? And actually, the HMRC, among other governments in the EU, have signaled their support for this. So I think it's a very interesting and important question. I guess I would like to maybe turn back to Tom and thinking about where David said about how the public is moving. There's an interest, there's a desire for public information that historically has been treated as confidential. Tom, do you think there's any prospect for the United States, and presumably this would take legislation, to change our definition of tax return information, and to actually see the United States government, publishing accounts of some type associated with particular taxpayers?
I haven't seen any evidence that that we'd like to move in that direction. I mean, you talked before about what's happening with the treaties and keeping information about U.S. individuals, U.S. companies quiet. I think that extends to this area as well. I mean, I think it's hard to see that happening. What I see possibly happening, on the other hand, though, and David alluded to this before, is the kind of revelations that can come out of the Transparency Project in BEPS, revealing what's going on in international tax planning. That's the kind of thing, in addition to inversions, that could drive international reform in the U.S. When the public sees corporations not paying tax on foreign earnings through international tax planning, that's the kind of thing that will get the public's attention when there's the other kind of forces that we see going on. We see the pressure on spending because of the deficit and the national debt, the need to raise revenue or cut spending, and the public will prefer increasing revenue as long as the revenue is not coming from them. So if they see potential revenues floating around in the Transparency Project in international earnings of U.S. corporations, that's the kind of thing that will get the public's attention and that the members may react to.
Well, let me then turn back to predictions. And so, David, you've been studying the BEPS agenda. You've been looking at the 15 action points. Of those, which ones do you think ultimately are going to be? Let's say, look out 5 years. Which one of those action points do you think will be the most significant of the various? Is it permanent establishment? Is it hybrids? Is it interest limitation?
You mean from a U.S. perspective?
From a U.S. perspective.
Well, I think I've mentioned the two that we've mentioned already. The two that I think are most significant, which is the C/C reporting and the mutual agreement improvements in the mutual agreement procedure. Although the BEPS action plan didn't produce anything, it in turn is generating a certain amount of energy there. I don't see us doing much about BEPS otherwise because 5 years in my world is a pretty short time. I'm probably even more pessimistic than Tom. I'm not only don't I think anything's going to happen in the election year, I don't think the election's going to change much in terms of tax reform myself. I don't see the opportunity for much legislation, and most of BEPS requires legislation. I don't see, unless something happens to our treaty program, there's no real point in talking about changing our treaties because we've been immobilized since November of 2011. We haven't done anything with treaties, and we're not likely to do anything at all unless somebody figures out a way either to change Mr. Paul's mind or to move around him somehow to get the treaties approved. If you take legislation and treaties off the table, there's precious little left for us to do with respect to BEPS, to be honest with you.
Okay. And Tom, sort of looking out, let's say 5 years, so coming a couple of Congresses, the list in your notes that everyone has, you've got a list of some of the different ideas that people are focused on. Which one or two would you think you would expect to actually be enacted? Say 5 years from now?
Well, if there's going to be any movement, I'm not sure who's more pessimistic here about, about the movement. you know, one of the interesting things that happened last year is there were some high-level discussions of international tax reform that didn't go, obviously didn't produce a proposal, obviously didn't move through Congress either, and it's not clear that there was any rank and file buy-in for it. But you know, the discussion was around the minimum tax base erosion proposal that the administration has out there that's actually pretty similar to what Dave Camp proposed in his comprehensive reform proposal. I mean, there was some fairly serious high-level discussions around that. Now, they couldn't agree on a couple of basic things, like, you know, what the minimum tax rate should be, and how much money they should raise from the reform. You know, whether it, you know, and how that money should be spent, whether it should be used for debt reduction or whether it should be spent on infrastructure. And, you know, and they were, you know, tens or hundreds of billions of dollars apart on the revenue issue, and, you know, 5, 6, 7 points difference on the rates, and the rate for taxation of repatriated earnings under that proposal. But the framework's there. I mean, the basic framework for a minimum tax proposal with base erosion protection and some sort of tax on accumulated earnings currently that would be brought back in a transition period. You know, the framework's there.
So you think a minimum tax, if you're looking out 5 years and you're thinking about the various, you know, sort of big ideas that are on the table, the minimum tax is the one you would pick?
Yeah, I mean, I think the people who've really thought about this a lot, I mean, that's where they've all come out. You know, they've all started in different places, but they've all sort of come to that, you know, that kind of conclusion. But when that could happen, I don't know, because they are so far apart on the parameters of it at this point. And as David points out, you know, there's not a lot of cooperation in Congress. We can't even get the treaties through. You know,
David, do you have a
Yeah,
comment?
do you see any appetite at all for another sort of Berlusconi-type amnesty bill like we had in 1984, 85?
For repatriating
Yeah.
earnings? No. And the reason for that is the revenue cost, if nothing else. You know, it loses a lot of revenue. The Joint Committee's estimated it a number of times. You know, people like to think that, you know, you bring the earnings back at a reduced rate, and that's money that you wouldn't get otherwise. The Joint Committee always says no for various reasons, because of the behavioral changes, the fact that, you know, doing some sort of a tax holiday for repatriating earnings encourages more income being shifted and operations being shifted offshore. On the one hand, on the other hand, what we're starting to see now, because of the huge accumulation of earnings offshore, is we start seeing some of it being brought back.
Yeah, but you could change that by changing the revenue estimating methodology. You could change the amount of the loss, right?
Yeah,
Well,
it's all just black box magic anyway, right?
That's right. That's right.
We actually do have time for a question or two, if someone has one. Okay, we got one back here. No, I'm going to not start in the.
David was referring earlier to the fact that if we do have international tax reform in the United States, it would be informed by and compared to the BEPS proposal. I wonder if you might give us some observations about a recent test of that proposition, the difference between affiliated interest expense limitation under BEPS and the new 385 regulation.
Yeah, I wasn't really saying, I have no illusions that in drafting legislation that Congress of the United States would pay attention to BEPS. I think that's a step beyond anything I was suggesting. I was simply saying that in considering legislation, certainly the staff and probably the commentariat is going to be thinking about BEPS. So the problem that we have here, I mean, the elephant in the room, frankly, is that we don't have a functioning legislature. And you can't do much without a functioning legislature, and you see it in those regulations because you sense the frustration in the executive branch of not being able to do things. And I just, for the life of me, don't see that changing anytime soon. So, and I don't think the election has much to do with it. I think the election could make it worse. So I'll outdo you on I'll see you one and raise you one on pessimism.
Well, I'd also point out in that regard that, you know, one of the interesting things about the campaigns is, you know, they all have their mandatory tax proposals out there. But when was the last time you heard them talk about it on the stump? I mean, they're not talking about taxes. It's
Or
not
thinking
really-
about it,
or-
it seems to me. I don't know.
Lee, you can he'll give you a question here.
work up to a question that I have the citizens about industry, okay? If we look at Camp as a whole, we see that in order to lower some rates, not even very much, within the budget rules, he has to evade a lot of tax expenditures, right?
Right.
On the corporate side, he has to repeal LIFO, he's got to repeal manufacturing deduction, he's got to repeal the fancy accelerated depreciation. And then if we look at, well, who was benefiting from all this planning, it's really to those industries. And you got other industries that really like LIFO, and really like, some of these bennies. So where are you gonna get, or do you
That's
even have
your slide.
unified business? I mean, don't you, if I'm a company, I mean, say, look, I'm not giving up my LIFO for my own inventory, so Google can pay less tax.
Yeah. No. So Lee's comment was that isn't there a really inherent tension between the
Winners
some
and losers?
industries are have benefits, others don't. So how does business come together on a proposal given sort of very disparate treatment under the tax code? Tom,
Yeah,
that's
I mean,
for you.
it's always a problem when you're doing anything like revenue neutral tax reform. What you're doing at the end of the day is redistributing tax burden, and that creates winners and losers. And what Lee's pointing out is there are clearly some losers under revenue neutral tax reform on the business side, the ones who are losing accelerated cost recovery, who are losing the U.S. manufacturing deduction, that are losing LIFO accounting, and potentially losing expensing of research costs. Yes, that was in there in Camp. Yes.
So I think Lee just has one more reason
so.
to be pessimistic about any changes. Thank you for your attention. We've enjoyed it. We hope you have, and we look forward to the rest of the day.